Welcome to another episode of Rad Accounting Tutorials. So today we are going to look at accounting concepts and conventions. Accounting concepts and conventions. Before we continue, take a few seconds to click on the subscription button to subscribe to my channel. So any videos that I upload, you're going to have a notification. Let's subscribe to the channel and let's make the channel big. So today we're going to talk about the accounting concepts and conventions. So accounting may be viewed as information system through which certain economic information about a business and other organizations is stored or analyzed. But then to be very objective, accounting information needs to be governed by some accepted rules and what conventions. That is the accounting concepts and conventions. We can't just be recording business transactions or presenting financial information without any rules governing this. So, for you to prepare your accounting information of financial statements, you need to get these rules to govern this. So, these rules and principles and laws is what we call the accounting concept and convention. So, accounting information needs to be governed by accepted rules and conventions. So these are the accounting concepts and conventions. So that is the whole idea about the accounting concepts and conventions. So when we talk about concepts, or what we are trying to say, it's some assumptions guiding or some rules guiding the preparation of financial statements or recording of business transactions. That is what we mean by the accounting concept and convention. So, what is an accounting concept? When we say accounting concepts and conventions, they are a set of rules, principles, postulates, conventions, and methods applied in the measuring and recording of business transactions and the reporting of financial information. That is accounting concepts and conventions. The rules and principles that governs the preparation of financial statements is what we call the accounting concept. Okay, so under the accounting concept, we have the accounting basis and the accounting policies. However, these two have some differences. When we talk about the accounting basis, they are the methods used for applying the fundamental accounting concept to financial transactions and events when preparing the financial statement. So an example is the method of depreciation. That is an example of the example is method of depreciation. So the method of depreciation is an accounting base. Another example that you can say is the method of um, inventory valuation. Do you get it? The method that you use in the inventory valuation can also be accounting base. So the whole method as in broad, it is the accounting base. I hope you are getting it. So it is methods used for applying. So all the methods that we use in applying now accounting, recording of all these are accounting bases. But then if you decide to adapt a particular method of depreciation, or you decide to adapt a particular method and you follow that method consistently in the preparation of your financial statement, now it becomes an accounting policy of the organization. So that is the difference. So the accounting business is broad, as in broad, but if you pick one and you adapt it and you consistently use it, then it becomes an accounting policy. So an accounting based an example is the method of depreciation. When I say accounting policy, so method of depreciation, picking the straight line method of depreciation or picking the reducing balance method. Now that becomes an accounting policy. So when you hear said accounting policies is that specific accounting base adopted and consistently followed by an entity in the preparation of its financial statement. So that is the difference between the accounting base. So another one that I can say with the inventory valuation method, what is we have FIFO and LIFO, we have weighted average. So if you decide to adapt the FIFO method, that's the first in, first out, and consistently follow that in valuation of your inventory, then that becomes an accounting policy. I believe it's I believe it's clear. So that is it. So these are some of the concepts that we have. So accounting concepts are referred to as they are often referred to as an assumptions. So these are the fundamental concepts that we have. So the first one is the going concern. The going concern concept assumes that the business will continue to be in normal operation for the foreseeable future. That is what the concept is saying. That when you are preparing your financial statements, you should assume the entity will, will exist for a foreseeable future. It will never collapse. Yes, that is what the going concept is saying. Don't assume that the business is going to collapse in the next year or the next 2 years, but then you should assume that the business or the organization will never collapse. It will exist to a foreseeable future. So that's where we when we purchase a non-current asset and we are depreciating, we say that we are going to depreciate the their non-current assets within 10 years or 20 years. We do this because we have the assumption that in the next 10 years, the organization will still be operating. So that is the going concern concept. The going concern assume that the organization will exist forever. It will never collapse. That is the going concern concept. Let's move to the prudence concept or the conservatism concept. So the prudence concept is also saying that don't anticipate for profit. Don't anticipate for profit, but then rather anticipate for losses. That is what the prudence concept is saying. So what it's trying to say is don't assume you're going to make this profit, but then rather assume that you're going to make losses. So the prudence concept, or what the prudence concept want to say is that you should rather understate your profits and overstate your what? Your losses. So that is what the prudence concept is. Don't anticipate for. So if you have, let's say you have debtors of 1,000 cedis, don't anticipate that you are going to receive all that 1,000 cedis, but then you should rather anticipate losses. That's anticipate that you will not receive all the 1,000 cedis. That is what the prudence concept is saying. That's where there is that's why we sometimes we make provision for doubtful debt. So it is because of the prudence concept that's why we make provision for doubtful debt. We are making provision for our doubtful debt. So if you have debtors of 1,000, we are assuming that we are not going to receive all the 1,000, but you are going to receive only 800. So you are going to make provision for what? 200 cities. That is the meaning of the prudence concept. Now let's move to the accrual and margin concept. So most times the accrual and margin concept comes together, but then it is sometimes separated. It is different. You need to understand both, but then they work hand in hand. That's why sometimes we add it the accrual and margin concept. So when we talk about the accrual concept states that revenue and expenses are accrued or recognized as they are earned or incurred not when money is received or paid. That is the accrual concept. Accrual concept is when it comes to the income side, don't record. You should, as soon as income is earned, you have to what? Record it. Don't wait to receive the money before you record it. That is the accrual concept. As soon as it is earned, that is, as soon as you render the service to the person and the person has not paid the money to you yet, you've earned it. So you have to record that income. And expenses, as soon as you incur the expenses, and although you've not paid for the expenses, you have to record the expenses because you've incurred it. That is what the accrual concept is saying. As soon as it is earned, record it. As soon as it's incurred, then you will you record it. That is the accrual concept. And the matching concept is saying what the matching concept is saying that we should match revenue against expenses. We should match revenue against expenses. So matching concept is saying that the expenses that you incurred within a period of time should be matched against that same revenue that was made within that period of time. So let's say in 2023 or 2024, the revenue that you made in 2024 should be matched against the expenses that you made in 2024. So don't take that expenses to 2025. That is the matching concept. So this is why the accrual and matching concept comes together. So the accrual concept is saying is that if you incur the expenses, you record it. So the accrual concept helps to achieve the matching concept. So although when it comes to the accrual concept, although you incur the expenses and it is not paid, you still record it. And this will help you to match the expenses to the revenue in that particular year. So let's assume you incur expenses in 2024 and you've not paid for it, but then you make payments in 2025 and you decide to because you paid the expense in 2025, you're going to record it for 2025. And it means you are not going to match that expenses to the revenue in 2024. But other expenses was incurred in 2024. That's why sometimes we add the accrual and matching concept. So the accrual concept helps to achieve the matching concept. So although you've not paid for it, but then record it. So that is it. And also you come to the comparability and so the comparability and consistency also works together. But then sometimes they are um, different, different concepts, but then they work hand in hand. You need to achieve this. This one helps to achieve the other. So in some books they combine both. So you have the comparability concept and you have the consistency concept. So the comparability concept is saying that there should be there should, so there should be some consistency in the treatment of similar items within each accounting period and from one accounting period to another. So that is what the consistency concept is saying. And this is going to enable what? Comparability. If there is consistency in the treatment of accounting, it's going to enable comparability. Consistency as in if you decide to adapt a straight line method in depreciating your non-current assets, you should be consistent in using that method to depreciate your non-current asset from period to period, from period to period. Don't use straight line method this year, and the next year you'll be using reducing balance method. Another year you'll be using this will not enable comparability. You won't be able to compare the accounting information. You won't be able to compare the financial statement. So what it's saying is that you have to be consistent in the treatment of accounting, and this is going to help the comparability. So these are some of the concepts that we have. Let's move on to the other concepts we have. So apart from the fundamentals, we have these other accounting concepts. One is the business entity concept. The business entity concept is saying that a business is an entity which is separate and distinct from its owners. So that is what the business entity concept is saying. The business entity concept is saying a business entity should be separate from its owners. So if the business is owing you, then the owner is not the one owing you, but then it is the business that is owing you. If you want to sue the owner, then it's go and sue the owner. Don't sue the company. So that is what the business entity concept is saying. It should be business or the organization should be separate from the owner. The resources of the owner should not be the same for it should be separate. It should be a separate entity. Now let's move to the money measurement concept. The money measurement concept is saying that accounting deals with only items with monetary values that are attributed. So if anything happens and it is not assigned with monetary value, we are not going to record it. Money measurement concept is saying that we should only record transactions with monetary value. That is the meaning of the money measurement concept. Now let's move to the materiality concept. The materiality concept is saying that if the omission or misstatement of an item would influence the economic decision of the user, then it is material. That is what the material concept is saying. If the omission or misstatement of an item in the financial statement can influence the decision of the economic user, then it is material. But then if it won't, then it is immaterial. For example, if you have an organization reporting 10,000 Ghana cedis as profits, and they later disclosed there was an omission of 100 cedis, 100 cedis expenses in their financial statement. So if this 100 cedis even takes effect, then the net profit is just going to reduce by 100 cedis. So 10,000 minus 100 cedis is very little. So this will not really influence the decision of the user. Therefore, this 100 cedis is immaterial and it's not material. But then let's assume the later, after reporting the 10,000 Ghana cedis net profit, they later said, well, there was this expense that we omitted. That's 4,500. There was this expense that we were supposed to include that we forward to 4,500. This is going to reduce the net profit to around 5,500. So you can see it will change the net profit hugely. You get it? And this can influence the decision of the economic user. So the person can decide not to invest in that company again. So since this can influence the decision of the user, then we see it is what material. That is the material concept. Again, when it comes to the materiality concept, it depends on the size of the company because what will be material to me will not be material to another company. So 100 cedis will not be material to company A, but it will be material to company B. So that is the meaning of the materiality concept. If the omission or misstatement of an item in a financial statement can influence the decision of the user, then it is material. If it won't, then it is immaterial. Let's move to the dual concept. That's the dual concept. The dual concept is saying that for every transaction, there should be two entries. That's the giving and the receiving aspect. So for every transaction, there should be two entries. That's where the double entry comes in. There should be two entries. That's the credit entry and debit entry. That is the duality concept. we have the periodicity concept. The periodicity concept is saying that financial statements should be prepared for a given period of time. You should not just be recording it. You can't tell that this one is from year to year. It should be recorded or prepared for a given period of time. That is the periodicity. And let's move to the historical cost. The historical cost is saying that the value of assets should be recorded in the books of accounts at their original cost at which they were acquired. That is what the historical cost is saying. We should record assets or liabilities at the original cost at which they were acquired. So if you acquired the vehicle 2 years ago at 20,000 or 30,000, if you are recording it today, record it at the original cost that you get it. That's the past cost and the historical cost. And that's what the historical cost is saying. Now let's move to the substance over form. The substance over form is saying that accounting transactions should be recorded and presented in accordance with their substance and financial reality, and not merely with their strict legal form. That is the meaning of the substance over form. Let me give you an example. So an example is when, let's say, an organization acquires a non-current asset on a hire purchase basis. So legally, or the organization goes for a lease of non-current assets. So legally, the non-current does not the non-current asset that is on lease does not belong to the entity. It does not belong. It does not belong to the entity because of the substantial and financial nature of the transaction. That is the benefit that will be earned from that non-current asset that has they borrowed from someone. This concept is saying that because of the financial nature of the benefit the beginning, they should include, although the legally the non-current asset is not theirs, they should record it in their financial statements. So that's why they are saying substance over form, and substance over the legal form. So legally it is not theirs, yes, but then they should record it because of its substantial and financial nature. They should record it in their books to tell users that we have this non-current asset in our organization, which is helping us generate revenue. So that is the substance of our form. Then let's move to the last one. The last one is the full disclosure. So the full disclosure is saying that in the presentation of financial statements, every information that is relevant and material which could influence the economic decision of users must be fully be disclosed. It must be fully disclosed. Whatever in the whatever is in the financial statements that is vague, that is not unclear, anything that you think it is relevant, that it will influence, anything that you think it is relevant and material, which you think it will influence the decision making of the user, should be fully disclosed. That is what we mean by the full disclosure concept. So these are some of the concepts that we have, and I believe you understand what we mean. So that's the end of accounting concepts and conventions. If you have any question, you can put them in the comment section. So subscribe to my channel. I have more videos. Subscribe to my channel. Click on the notification bell. Anytime a new video is uploaded, you'll be notified. Bye bye. See you in my next video.